I'm Eric Fine, and I'm responsible for VanEck's emerging market fixed income strategies. So there were two key developments in the second quarter. The first were there was a lot of politics, and the emerging markets saw South African elections, which ended up pretty much okay in a market-friendly direction, Indian elections, which also were elections of continuity, and Mexican elections, which looked unstable, but that was more about the heavy positioning in Mexico more than it was about bad policy. You also had developed market elections. You had elections in France, and in France, they coincided with the German finance minister questioning whether the central bank, the ECB, can buy French bonds to support any volatility. That's a profound risk, very different from the EM political developments that I mentioned. You have the US, where there are regular financial media questions on the independence of the Fed. Again, a profound policy and political discussion that's not happening in these emerging markets. Similarly, you have Japan, though it didn't face any big political events, continuing to see its currency and bond markets weaken. These are developed markets going through serious political and policy risks that are arguably unpriced. And I think this is a real solid juxtaposition against the EMs that saw noise that was largely unwarranted. The second big development after politics in the second quarter was that US rates rallied. There had been a concern that especially long-dated bonds, 10 years and 30 years, were going to sell off, and that the rate cuts that the market had been pricing in would continue to get priced out. That didn't happen in the second quarter, and that generated fairly okay returns for some bond categories. However, the decline in yields was generated much more by concerns on growth and jobs than it was in the decline in inflation. So it does hold the power to bring yields down, but if inflation doesn't cooperate, a few months from now, it could create further risks. Those are the two key developments. A lot of politics, which I think made EM look okay despite the noise, made DM look much more worrisome. And the other big event was the decline in yields, especially duration in treasuries. So what do these developments in the second quarter mean? What do they mean for investors in the short term and the long term? Number one, our mantra has been, and we've been quoting Mark Twain on this, it ain't what you don't know that's going to get you, right? It's not these EM risks that seem high that's going to get you. It's what you know for sure that just ain't so. It's the massive investment that's in developed market bonds that's probably more worth worrying about. So I think that's the biggest takeaway. I'll give you the examples. In South Africa, despite the noise, you have an alliance between the ANC and the very market-friendly DA. This is a really good outcome, and South Africa is one of the only currencies in the world that's strong against the dollar this year. We had an overweight, and we stayed overweight. Didn't do anything. That one's working, and the outcome was good despite a couple days of noise. Mexico, we went in extremely underweight. The market blew up because it was very heavy, and it got surprised by the election outcome, a better than expected outcome for the prior new incoming government that raised issues of what are they going to do with this power policy-wise. Well, they've since come out with a very orthodox finance ministry appointment and a number of comments that they're going to maintain fiscal orthodoxy. To the extent that there are risks in Mexico, we don't see them out of fiscal, which means it's very hard for us to map these to adverse outcomes for the Mex peso or for Mexican rates. What did we do about it? We bought more. We had a big underweight. Market was too heavy. It blew up, adjusted by over 10%, and we bought more. So those, I think, particular meanings is these sell-offs create opportunities in EM to essentially buy. I'll give you the bottom line so far of how this is represented. In other words, I said the implications are it's good for EM and bad for DM. Let's look at what's actually happened year to date. Year to date, our fund is up 55 basis points. Our benchmark's down 72, and the global ag is down 3%. Treasuries are down 2%. So year to date, yet again, EM is doing much better than DM, and our fund is outperforming. And this has been going on for 5 to 20 years. We've shown the papers on that. So I think we're seeing a lot of developments that are very consistent with EM outperforming DM. The risks are much more in DM. They're not priced. The risks in EM are arguably overpriced.